You know that feeling when you finally have $1,000 sitting in your bank account and you're wondering what the heck you're supposed to do with it. Like, should you invest it? Should you save it? Should you just throw it at whatever sounds exciting? Well, you're not alone. Most people get to this point and they completely freeze because they think investing is something that only happens in boardrooms with guys in expensive suits making complicated trades. But here's the thing that nobody tells you. Investing your first $1,000 is one of the most important financial decisions you'll ever make. And honestly, it's way simpler than you think. My name is Nick, and I help people understand money and investing without all the fancy Wall Street mumbo jumbo. And let me tell you something that might surprise you. The person who invests their first $1,000 correctly often ends up wealthier than someone who throws $10,000 at whatever stock is trending on social media. It's not about how much you start with. It's about understanding the fundamentals that most people completely ignore. But remember, I am not a financial advisor. This video is for educational purposes only. Please do your own research before investing. Now, before we dive into the step-by-step process, let me make you 3 promises. First, everything I'm going to show you can be done with simple language and zero financial jargon that makes your eyes glaze over. Second, we're not going to talk about day trading, cryptocurrency, or any get-rich-quick schemes that sound too good to be true, because they usually are. And third, by the end of this video, you'll have a realistic plan that anyone can follow, regardless of whether you think the stock market is some mysterious casino or you're just tired of watching your money earn basically nothing in a savings account. But here's what separates this video from every other investing tutorial you've probably watched. I'm going to show you the one step that most beginners skip entirely, and it's the reason they lose money before they even get started. Plus, I'll reveal the exact account type that can save you thousands in taxes over the years and the simple 3-fund portfolio that has consistently beaten 90% of professional money managers. However, before you get excited and start throwing money at the stock market, we need to have an honest conversation about something that might hurt your feelings a little bit. Your $1,000 might not be ready to invest yet. I know that sounds crazy, especially when you're watching videos about investing, but hear me out because this could save you from making a financial mistake that takes years to recover from. Step 1 is protecting that $1,000 before you even think about investing it. And this is where most people roll their eyes and click away because they want to skip straight to the exciting part. But the wealthy people I know didn't get wealthy by skipping the boring stuff. Like, they got wealthy by doing the boring stuff really, really well. Here's the reality check nobody wants to give you. If you don't have at least 1 month of basic expenses saved up somewhere safe, then investing your $1,000 is like trying to build a house without a foundation. It might work for a while, but when life inevitably throws you a curveball, you'll end up selling your investments at the worst possible time just to pay for an emergency. Let me paint you a picture of what this looks like. You invest your $1,000 and 3 months later, your car breaks down. The repair costs $800. If you don't have emergency savings, you'll have to sell your investments to pay for it. And here's the cruel irony. The market will probably be down when you need that money most, because that's just how these things work. So you'll sell at a loss, pay the repair bill, and swear off investing forever because you think it doesn't work. The emergency fund doesn't need to be huge when you're starting out. If your basic monthly expenses are $2,000, then having $2,000 in a high yield savings account gives you that buffer. If your expenses are lower, then you need less. The point isn't to have 6 months of expenses saved before you start investing. The point is to have something there so you're not forced to sell your investments during the first minor financial hiccup. Now, let's talk about the elephant in the room that makes people really uncomfortable. Credit card debt. If you're carrying a balance on credit cards that charge 15, 20, or 25% interest, then investing your $1,000 is like trying to fill a bucket that has a giant hole in the bottom. Think about it mathematically. The stock market historically returns about 10% per year on average, but your credit card is charging you 20% guaranteed, so you're essentially borrowing money at 20% to invest it at 10%. which is a losing proposition that would make any reasonable person question your math skills. I know this isn't what you want to hear. You want to start building wealth through investing, not pay off boring debt. But here's the thing about wealthy people. They understand that paying off high interest debt is actually one of the best investments you can make. It's a guaranteed return equal to whatever interest rate you're paying, and there's no risk involved. However, and this is important, I'm not saying you need to pay off every single dollar of debt before you start investing. If you have low interest debt, like a mortgage at 4% or a car loan at 6%, you can absolutely invest while carrying that debt because your potential investment returns are higher than the interest you're paying. The rule of thumb is pretty simple. If your debt has an interest rate above 15%, pay it off before investing. If it's below 15%, you can probably invest while paying the minimum on that debt. And if it's somewhere in between, well, that's where you need to make a judgment call based on your personal situation and risk tolerance. Assuming you've got your emergency fund sorted and you're not drowning in high interest debt, let's move on to step 2, which is choosing the right account to invest in. And this is where most beginners make a mistake that costs them thousands of dollars over the years simply because nobody ever explained the difference between account types. When most people think about investing, they imagine opening some generic investment account and throwing money at it. But the type of account you choose is almost as important as what you invest in, because it determines how much of your profits you get to keep versus how much you hand over to the government in taxes. There are 2 main options for your first $1,000, and understanding the difference could literally save you thousands over the next few decades. The first option is a Roth IRA, and for most beginners in 2026, this is probably your best choice. The second option is a regular taxable brokerage account, which has its own advantages depending on your situation. Let me explain the Roth IRA first because it's probably the most powerful wealth building tool available to regular people, yet most people either don't know about it or don't understand why it's so incredible. With a Roth IRA, you put in money that you've already paid taxes on. So if you earn $1,000 at your job, the government takes their cut and then you invest whatever's left. But here's where it gets interesting. Every dollar of growth in that Roth IRA is completely tax-free when you withdraw it in retirement. Let me say that again because it's important. Tax-free. Not tax-deferred, not reduced taxes, 0 taxes on the growth. So if you invest $1,000 today and it grows to $50,000 over the next 30 years, you can withdraw all $50,000 without paying a single penny in taxes on that growth. The government gets nothing. You keep everything. And when you think about how much that could save you over decades of investing, it's honestly a little ridiculous that more people don't take advantage of this. There are some rules, of course, because the government isn't completely stupid. You can only contribute a certain amount each year. In 2026, the limit is $7,500 if you're under 50 or $8,600 if you're over 50. And there are income limits, but if you're just starting out with $1,000, you're probably well below those limits. The main downside of a Roth IRA is that your money is generally locked up until you're 59 and a half years old. You can withdraw your original contributions anytime without penalty, but the growth portion is stuck until retirement age unless you want to pay penalties and taxes. This is where the taxable brokerage account comes in as your second option. With a taxable account, there are no contribution limits, no income limits, and no age restrictions on withdrawals. You can invest as much as you want, whenever you want, and access your money whenever you need it. The trade-off is taxes. When your investments make money in a taxable account, you'll owe taxes on those gains. The good news is that if you hold your investments for more than a year, you'll pay long-term capital gains rates, which are usually much lower than regular income tax rates. But it's still more than the 0 taxes you'd pay in a Roth IRA. So, which should you choose for your first $1,000? If you're investing for long-term goals like retirement and you don't think you'll need the money for at least 5 years, the Roth IRA is probably your best bet. The tax-free growth over decades is just too powerful to ignore. But if you're investing for shorter-term goals or you want the flexibility to access your money without restrictions, then a taxable brokerage account makes more sense. There's no wrong choice here, just different tools for different situations. All right, once you've decided on your account type, step 3 is where things get really interesting and honestly where most beginners either make their fortune or completely sabotage themselves without even realizing it. We're talking about what to actually buy with that $1,000, and I promise you the answer is going to be both simpler and smarter than anything you've probably heard on social media. But before we get to the good stuff, let me tell you what not to do, because avoiding these mistakes is probably more important than getting everything else perfect. Do not, and I cannot stress this enough, do not take your first $1,000 and buy stock in whatever company your cousin's friend mentioned at a barbecue last weekend. Do not buy whatever stock is trending on Reddit because a bunch of people with usernames like DiamondHands420 think it's going to the moon. And for the love of all that is financially responsible, do not try to day trade your way to riches. I know it looks exciting when you see those screenshots of people making thousands in a day, but what they're not showing you are the screenshots of all the money they lost the other 90% of the time. Day trading with your first $1,000 is like taking your rent money to Las Vegas and putting it all on red. Sure, you might win, but you're statistically more likely to end up eating ramen noodles for the next month while explaining to your landlord why you're short on rent. Here's what successful long-term investors understand that the get-rich-quick crowd doesn't. Boring wins, consistency wins, and buying tiny pieces of thousands of successful companies wins a lot more often than trying to pick the next Apple or Tesla before anyone else figures it out. So, what does this actually look like for your $1,000? I'm going to give you the exact strategy that has created more millionaires than any other approach. And it's so simple that most people assume it can't possibly work. We're talking about a 3-fund portfolio, which sounds fancy, but is actually just financial professional speak for not putting all your eggs in one basket. Here's how I'd allocate that $1,000 if I were starting over today. 60 to 70% goes into a total stock market index fund or an S&P 500 index fund. This gives you ownership in hundreds or thousands of the most successful companies in America. We're talking about Apple, Microsoft, Amazon, Google, and hundreds of other companies that people use every single day. The beautiful thing about this approach is that you don't have to be smart enough to figure out which individual companies are going to succeed. You're essentially betting on the entire American economy, which historically has been a pretty good bet. When these companies make money, you make money. When they grow, you grow. And when they pay dividends, you get paid too. The next 20 to 30% of your $1,000 goes into international index funds. Now, I know what you're thinking. Why would I invest in foreign companies when American companies are doing so well? And that's a fair question that shows you're actually thinking about this stuff, which puts you ahead of most people. The answer is diversification, but not the kind of diversification that financial advisors usually bore you to death talking about. This is about not having all of your financial future tied to one country's economy, no matter how awesome that country might be. Sometimes international markets do better than American markets. Sometimes it's the other way around. By owning both, you're positioned to benefit regardless of which one is having a good year. Plus, there's something psychologically comforting about knowing that your investment success isn't completely dependent on American politics, American economic policy, or whether Americans decide to keep buying stuff. You're spreading your risk across the entire global economy, which is about as diversified as you can get without making things unnecessarily complicated. The remaining 0 to 10% can go into bonds if you want to be extra conservative, but honestly, when you're starting with just $1,000 and you're presumably young enough to recover from any market downturns, you probably don't need bonds yet. That's money that could be working harder for you in stock index funds. Now, you might be wondering about specific fund names. Here are popular examples of funds that track these markets. For your total stock market exposure, you're looking at funds like VTSX from Vanguard, FXAIX from Fidelity, or SWTSX from Schwab. These are all slightly different ways of owning basically the entire American stock market, and they're all perfectly fine choices. For international exposure, you've got options like VTIX, FTIHX, or SWISX. Again, these are just different flavors of the same basic idea, which is owning pieces of successful companies from around the world. The specific fund you choose matters a lot less than actually choosing one and getting started. And here's something that might surprise you about these index funds. They consistently beat about 90% of professional money managers over the long term. These are people who went to fancy schools, wear expensive suits, and spend all day trying to outsmart the market. And yet, your simple approach of buying everything and holding onto it tends to work better than their complex strategies. Why does this happen? Because when you buy an index fund, you're not paying someone a huge fee to try to be smarter than the market. You're just accepting whatever return the market gives you minus a tiny fee that's usually less than 1% per year. Meanwhile, those active fund managers are charging 2 or 3% annually, plus they're constantly buying and selling, which creates tax consequences and transaction costs. It's like the difference between taking a direct flight to your destination versus connecting through 5 different airports, because your travel agent thinks they know a better route. Sometimes the complicated approach works, but most of the time you just end up paying more money to get to the same place later than if you'd kept things simple. Like, the other beautiful thing about this approach is that it scales perfectly as you add more money over time. Whether you're investing $1,000 or $100,000, the same basic strategy works. You're not going to outgrow this approach and need to completely change everything as your account balance increases. Speaking of adding more money, let's talk about step 4, which is setting up the systems that turn your one-time $1,000 investment into a wealth building machine that runs on autopilot. Because here's what most people don't realize about investing. The $1,000 you put in today isn't really about the $1,000. It's about building the habit and the systems that will help you consistently add money over the years. Like, the most successful investors I know aren't necessarily the ones who started with the most money. They're the ones who figured out how to consistently add money to their investments month after month, year after year, regardless of what the market was doing or how they were feeling about their investment account balance on any given day. This is where automation becomes your best friend. Most brokerage accounts will let you set up automatic investments where they pull a certain amount from your checking account every month and invest it according to whatever allocation you've chosen. So if you decide you can afford to invest $200 per month going forward, you can set it up once and then forget about it. The psychological benefit of this approach cannot be overstated. When the market is doing well and you're feeling great about your investments, you'll invest your $200. When the market is crashing and you're convinced the world is ending, you'll still invest your $200. When you're busy with work or distracted by life and completely forget about your investment account, you'll still invest your $200. This removes all of the emotional decision making that destroys most people's investment returns. You're not trying to time the market or figure out whether this is a good month to invest or a bad month to invest. You're just consistently buying more shares regardless of what the price happens to be, which means you'll automatically buy more shares when prices are low and fewer shares when prices are high. Over time, this approach, called dollar cost averaging, smooths out the volatility and helps ensure that you're not accidentally buying everything at the peak of the market. It's not a perfect system, but it's a system that works well enough that you can set it and forget it while focusing on the more important things in life, like actually earning more money to invest. Look, I'm not going to lie to you and say that your first $1,000 is going to change your life overnight. It won't. But What it will do is something far more valuable. It will prove to yourself that you can build wealth, that you can make smart financial decisions, and that you're not destined to work until you're 70 just to afford cat food in retirement. That $1,000 is your declaration of financial independence, even if it doesn't feel like much right now. 30 years from now, when that simple investment strategy has grown into something that actually can change your life, you'll look back on today as the day everything shifted, the day you stopped making excuses and started building the future you actually want.